So, so why property? So we'll cover a few different things, but before we go into um, everything else, we just get this out of the way. The disclaimer, just so you know, this following presentation is not considered your personal circumstances and cannot be used as an investment strategy. The numbers should be a guide only. Consider speaking to a qualified professional before making financial decisions. So just a disclaimer, we've not considered your personal financial situation. So apart from broking, I'm also a property investor myself. My husband and I, we hold a $7 million property portfolio. So I will not be talking just from things that I have researched over ChatGPT, but I will be talking about things that I have we've walked the path and things that I have also seen our clients achieve over the years. So take a pen and a paper, ask questions, and then most of all, take action. So we're going to cover property market fundamentals, where the market sits right now. Then we'll talk about from renting to owning. Then after you own, we'll talk about building wealth. So so this is just something for you to think about. You probably have heard that, buying a home, well, Australians consider buying a house is the Australian dream. Although only, a few people own more than six plus properties. So 6.1% of all Australians own at least one property. 1.6%, at least two. So
Okay.
the numbers go down with the number of properties. So people who own six or
Tu me
more,
fais.
people who own six or more sit around 0.01%. So a very, very small percentage own plus six properties. And I would like to uh, think this is more because there's a gap in terms of information. So people would want to, if people would be equipped with the right information, the right reasons why they should buy, or the right areas to buy, etc., I'm sure many people would make an informed decision. So you would see that, yeah, a very small percentage of Australians actually are owning six plus properties. In terms of the market fundamentals, we've had increased migration with Perth, Western Australia receiving most of the migration. We've got an acute shortage of supply. This is dating back from, pre-COVID, yeah, after COVID era, where a lot of builders went under and there was not enough tradesmen to complete even the existing build. So we still have an acute shortage of supply. Vacancy rates in most states are actually below 1%. So, and yeah, I was looking at sometime last year in Western Australia, the vacancy rate was 0.4%, literally meaning someone is moving out and someone is moving in. So we don't have enough supply. Interest rates have peaked, as you have seen. Interest rates had peaked. Now we've had an interest rate rise again after three interest rate cuts last year. We've had one interest rate rise, and they are expecting that there will be at least one more interest rate rise around May. Interest rates peak precedes a new cycle. That's what the data shows us, that each time we've had interest rates peak, it has been followed by a property boom. And the property market has been on the rise since March, and this is not March this year, this is March of the previous year. So the market has been on the rise, and I'll show you some of the performance of the our states and regions nationally. The annual percentage change is 8.4%, so well above the average of 7.2%. And if you look at other areas, Brisbane, the rest of Queensland, Adelaide, rest of South Australia, which includes the regionals, Western Australia, Darwin, they all posted double digits in the last 12 months. So this data is as of January. So it's just showing you the growth in the last 12 months for the different areas. And what you can also see is Melbourne, which has been lagging behind, is starting to wake up a little bit. But what you can also see is the disparities in the median house price between Sydney and Melbourne, although Melbourne is now sitting above Sydney in terms of population. And then on this graph, what you can also see, so what I've had a lot of clients, really struggle to say, should I really spend 800,000 on an investment property? Because in most areas now, in the metro areas, you would need to spend at least 750 to 800. That is, I'm talking about Western Australia, Queensland, South Australia. The market has moved so much that you're looking at, above 750 for something decent. But what you can see on this graph is we are not to ignore regional areas. As you can see here, the regions have actually outperformed the cities. So if you can see the red line are the capital cities, and the blue greenish line is actually the regional areas. So there's no evidence to show that the metro areas outperform the regions. So you can actually put your money in the regions and make money in the regional areas. They've actually outperformed. And you can also see that the peak really peak. The peak of the regions are higher peaks. Then going on to, I thought I would just show you some of the what's happening in the market, and then I'll talk about from renting to owning. What does it mean if you are renting? So if you are renting, you are still paying a mortgage. It's just somebody else's mortgage. So what I've put here on the screen is you would say what if you are renting, how much you are paying towards your landlord's mortgage. If you are on a 120,000 income, for example, and you buy an investment property at 6%, so 6% who pays for an investment property at 6% interest? 73% is the tenant. If you are an investor and you're on the 120,000 income bracket, 22% is the taxman, and then the smaller percentage is the investor. 5% is you if you're holding such an investment property. If you're holding an investment property on a $200,000 income, this is what the tenant pays. So 72% is paid by the tenant, 28% by the taxman, and 0% by you. And the reason I refer to part of this being paid by the taxman is because everything to do with that investment property is actually tax deductible. So your owner's rates, your owner's water bills, your repairs and maintenance expenses, they are all tax deductible. Then if you're on a dual income, maybe husband and wife, I just did a demo for maybe husband is 150, wife is on 75,000 annual income. Your tenant would pay 74% of that mortgage, 24 by the taxman, and then 2% by you. So in other words, you are holding an asset that someone else is paying for, but that will eventually help you to build wealth or eventually get out of debt. So I just wanted to have you a clear picture to say, owning is actually better than renting. So if you're renting, you'd rather rent vest, which is you're renting in a place that you like to live, but you own an investment property somewhere where you can afford. But if you're renting and you don't own an investment property, you're giving too much money away to the taxman and you're paying somebody else's mortgage. And then in terms of getting into the market, what's the easier entry point? So the easiest entry point is obviously utilizing all your first home owner incentives. Here in Victoria, if you're a first home buyer, now from October last year, they've opened up the Australian deposit scheme. So the Australian deposit scheme allows you to enter the market with a 5% deposit and you don't pay lender's mortgage insurance. So previously, that Australian deposit scheme was means tested. You needed to earn a certain income for you to qualify. But as of October last year, they've opened up to almost everyone. So, and that is seen now a lot of people, even the high income, those who work in the mines that earn a high income, they now also qualify for the scheme. Because now it's now almost everyone, as long as you're an Australian citizen or you're an Australian permanent resident, you qualify for the 5% Australian deposit scheme. If you're a single mom or single dad, you would only get away with a 2% deposit under the scheme. Obviously, the scheme has got some price caps. You can only buy property worth so much, but those caps have also been extended since October last year. So the easier point to enter the market is utilizing all the government incentives and schemes, which is that Australian deposit scheme. And also, if you are building in Victoria, you would qualify for a 10,000 first homeowners grant. Similarly, New South Wales, Western Australia, NT, you qualify for 50,000 first homeowners grant. Queensland, they currently have a 30,000 first homeowners grant. So getting into the market at that point is the easiest part. And then you begin to ride the wave with others in terms of property growth. And then if you are thinking of getting into the market, stay away from bad debt. What is bad debt? Bad debt are your credit cards, the buy now, pay later schemes. I always say if you can't afford it, don't buy it. So there's always a catch, there's no free lunch. So if you cannot afford it, just don't buy it. Stay away from those credit cards and all. And for credit cards, for your information, they don't assess your repayments based on the credit balance. They assess your repayments actually based on the limit. So, for example, if you've got a $20,000 credit card limit and you only owe 400 on it, they'll calculate your repayments at 3.8% of the 20,000, which is the limit. So that really takes away some of your borrowing power. So stay away from bad debt. We want good debt, which is debt that brings us money, debt that grows us wealth, and that brings us some cash flow. And then how do banks assess your borrowing power? So when banks look at how much you can borrow, they are not looking at actual repayments. They put a 3% buffer. And this is a mandate by APRA post the global financial crisis. They want to make sure that in the event that interest rates go up, you can still afford to keep paying your mortgage. So you're not actually, so if interest rates are at 5.6%, for example, you are actually being assessed at 8.6%. If the interest rate is at 6%, the actual, you are assessed at 9%. So they put a 3% buffer, and I'll show you some of the things that they look at when they are assessing you for your borrowing power. So this calculator this feature is called Quickly. But what Quickly pretty much does is if I enter your annual income, husband and wife, 2 kids living in a certain postcode, Quickly would flash out how much they can borrow you. So they are looking at your income, they are looking at your living expenses, they are looking at your existing liability position, and they're looking at your savings. So if you can look up the top here, so on the left, we've got all the lenders. So it would spit out all the 50 lenders. But what you can see here, they're looking at debt to income. So DTI just means debt to income ratio. and they are looking at the actual rate. You can see the actual rate here with 5936.01. So it gives us all the interest rates that the lenders are offering. Then you can see that assessment rate that I was talking about, that they add a 3% buffer to assess you for your borrowing power. So they call this an assessment rate or a sensitized rate. That is what they use to assess your borrowing power. HEM is just a household expenditure measure. So even though you may go and declare that I spend $1,000 on living expenses every month, they don't take your word for it. They would look at your postcode, the number of people in your household, and your income, and then they would spit out this HEM. That's the minimum living expenses that they would take for this current client that I have popped on the screen. So they're not so, and what you can see here is these living expenses are very different from lender to lender. Some lenders are more generous than the others. Some, assign more, as you can see here. Asset Line Capital is assigning 5,732 living expenses. So that also impacts on borrowing power, how much you can borrow from that particular lender. That's why lenders, it can vary, your borrowing capacity can vary from lender to lender because they're not, when it comes to living expenses, when it comes to how they assess your income, they all, do chop and change a few different things. So this is what they are looking at. So they are looking at your income, how much you earn, but it's not so much how much you earn. Yes, how much you earn is important, but your liability, your existing liability position, what you owe. So you can actually be earning, seven figures, but if you've got lots of credit cards, lots of personal loans, those things will be taking away some of your borrowing power. So on average, for every dollar you earn, most of these lenders would give you $6 in terms of borrowing power. So these are some of the things that they're looking at. So it's important if you're a first home buyer to make sure that you clean up on the bad debt, those credit cards, buy now, pay later schemes, clean up on those because also they want to see that you've got discipline of putting money aside and you're just not living on the credit cards. So those are some of the things that they are looking at when they are assessing you for a home loan. Any questions? Or I keep going, then we do questions at the end.
Yeah, I think keep on going.
Okay. And then, so
Next
moving
question,
on to the next part. So I was just wanting to lay the foundation to say the easier entry point is to start with your home. Starting with your home, because then you maximize all your government incentives and then you can build up. Because once you've got your home, you're already starting to build up equity in that home, which you can then use. So to buy the next home, it's easier because now you don't have to have cash savings. The lenders can take the increase in your current home, which is what they call equity, as a deposit to purchase the next one. So once we've got the first home, we are now set to start building, on the first block, which is our home. Then we are now set to then build wealth. And by wealth, I mean being able to retire at your own terms or being able to at least, be able to assist your kids to get into their first homes, etc. As you can see that the market is not stopping. I'm sure you hear it on the media all the time that, oh, first home buyers are going to struggle. So now a lot of people, so almost each time as the market increases, and it doesn't increase at the same rate as inflation, unfortunately. And each time the market increases, it's less and less affordability for people. So now it's taking almost 7 years on average for a first home buyer to save for their first home. And by the time they finish the saving, the houses that were 700 will probably be now worth 850, 900 or $1 million. So you just cannot save your way to wealth, but you can invest your way to wealth. So I'm sure you have had this, a lot of retirees coming out complaining, the retirement income is not enough. They're not being given enough. They're always, wanting to lobby for more income because truly it's not enough. The last time I checked, if you are a single person on a pension, you would get about 21,494 per year, which is like 826 per fortnight. If you were a couple, 42,000. So if you look at what you're spending right now is way more than what these guys are getting. So what that means is the pension is not going to be enough. And a lot of us, especially people like myself who were not born here, we never had a McDonald's job or anything like that. We don't even have enough super to cover us or to carry us through retirement. So what that means is we need to be smart, financially smart, and be able to make better decisions during our active working life. So what is wealth? So wealth is really your asset base times time. You build your asset base as big as you can with the money that you can afford and hold it for a long term. So I'll give you an example. Like I said, we hold a $7 million portfolio. If that portfolio last year we probably made maybe 500,000, give or take, in capital growth. But let's say that portfolio grows just 10% this year. It means we'll be sitting on 700,000 that we didn't have to work hard for, that we've got other people paying for those assets. A lot of the properties that we now have are on the positive, or some are neutral to positive, but majority of them, they pay for themselves. How do you calculate your current net worth? So you look at your assets, you look at your liabilities. So you add all your assets, then you take out all your liabilities to come up with what's your current net worth, how much are you worth, and look at whether that figure would be able to carry you through retirement. So wealth levels here you can see. If you retire on 300,000, if your net worth is 300,000, it means that will only give you $300 per week, and you're actually on the poverty line because that's not going to be enough. 300 per week is not enough for anything, even in today's money. And 500K, you're between 400 to 500. So it means you just need more money now to retire. And guess what? They have increased the retirement age to 67. So maybe by the time we retire, it will be 70, which means you would need to work longer because you don't have a choice, but you just have to keep going. So and I've met a lot of retirees, friends, and I always ask the question, self-funded retirees, and I always ask the question to say, how did you fund your retirement? And the answer has always been the same: through property. Majority of them have managed to self-fund their retirement through property. Okay, the power of leverage. So compounding plus leverage, economics 101, if you remember what we were taught at school. If you've got 100,000 today in the bank and you leave it in the bank earning an interest at 7% interest compounding, for 20 years, you'd be having 400,000 in the account. It's not bad. But if you take that 100,000 that you've got and you leverage on it, leverage meaning you borrow the bank, so you use the bank's money and you buy a property for 509, in 20 years, that property will be worth 2 million. So that's just giving you what the power of leverage can do and the power of compounding. That means now you no longer have just the 100,000 working for you, but you've multiplied that 100,000 and you have almost the 10x your return on investment. So it's important to think about these things when we've got cash in the bank or when we're sitting on equity in our homes. If you leave it in there and never do anything about it, you may not be able to 10x your return on investment, or you may not be able to grow your money as much. So here I've just done a quick comparison of someone who may purchase 4 properties. So we start with property number one, being our own home that we said, the stepping stone is, at least getting into our own home and stop renting. We start with property number one. Then in year two, we get property number two. Year three, maybe we've got some equity there. We purchase property three, we purchase property number four. And how much these properties, and not even growing at 7.2%, just growing at a very conservative growth rate. I've forgotten what I used here. I may have used the 4.5%. I wanted to be as conservative as possible. And just paying interest only on this. So, meaning we are not reducing the debt. We are only paying the interest to the bank and what that can do for us in 15 years. So you can be able to see there what that can do for us in 15 years. We can be able to build substantial amount of equity to retire on. Okay, so these are some of the examples. So there are other incentives for certain professionals. So registered nurses, you can actually get away with a 10% and you don't pay lender's mortgage insurance on investment properties. Civil engineers, not civil engineers. So engineers, there are some lenders that will pay the lender's mortgage insurance for you. Accountants, lawyers, physiotherapists, OTs. There are also other lenders that can look at certain professionals and be able to do 10% even for an investment property for certain professionals. Okay, this is an example of the first property that we purchased. So this, in terms of purchasing, the other question I get is, which is better, a unit or a house? So what happens is with property, what increases in value is the land, not the building. So the land is what goes up in value. So I'll give you an example of this property. We purchased this property in Bentley in 2011, and we couldn't even afford to live in Bentley. It's an expensive suburb. So we rented this property out and we continued renting elsewhere. But later on, after learning a few things, we discovered that this was not a good buy. It didn't make us a lot of money. We held it for 10 years. It only made us a profit of 175,000. Yet we've got properties that we purchased for less. So we purchased another property for 307, and it grew to 650 in 7 years. So the key learning here is, if you can, depending on your capacity, get a house. Houses will always outperform units and apartments. And then, at the lower end, an apartment. But with an apartment, you don't even own the land. So you're better off with a house if you can, a unit second, and maybe an apartment last. Because we discovered that although Bentley was a top market suburb, we could have made more money in areas that were not even top markets, but just the difference between the performance of units versus apartments. So I've covered quite a lot of things here. I would want to now round this up and leave time for questions. And hopefully I've covered everything, Rolly, that you wanted me to touch on.
For sure. Thank you. Thank you so much, Gracious. That was an excellent presentation. I've learned a lot personally. And before I open to the rest of the people to ask their questions. Maybe you can. I've been inspired by your story that you've built $7 million portfolio. I didn't know that, so well done to you and your husband and your family. I think that's a good achievement, and I'm sure many other people here have been inspired. Perhaps you could, give us share your story, Father, on how when you bought. You said 2011 for the first property. When did you buy your second property? How did you build to the $7 million amount?
Thank you.
Just to
So,
inspire the people here.
yeah, no, thank you. So ours is yeah, we didn't have any parents. We were international students. So my husband and I, we were international students. We met here. He was at Melbourne Uni doing his PhD. I was at Deakin doing my undergrad. So, we did all the hard yards. But what happened is in 2011, when we got married, we got money. You know how you get money at your wedding. We got money. And then with that money, we said, what do we do? And we said, let's buy our first investment property. So the money from our wedding funded our first investment property. And like I said, it was an area where we couldn't even afford to live. It was an expensive area. And then fast forward 2013. So 2 years later, we then bought our own home, but we actually leveraged off the equity from the first investment property. So now we had built enough equity in the first one to buy the second one. And then we kept building. So we've probably bought a property almost every year that we've been married. We've, in some years, buying two. We also have commercial. So we've got a mix of both. We've got commercial and we've got residential. My love for property dates back from my upbringing. My father used to love property and owned property. So I kind of had an idea that, you can't go wrong with property. And some of the properties we bought in not so upmarket areas. So I always tell clients that investing doesn't have to be expensive. I'll give you an example. We bought a property in 2021, in 2016 in Corayo, if you know Corayo in Geelong. Corayo is like, it's like it was like it's still a really not so upmarket area. We bought a property for 212,000 in Corayo. It was a three-bedroomed, nothing to write home about. It was just like a basic. And my husband said to me at the time, "Oh, this is the worst investment property we've ever bought," because it really was not. It was, yeah, one of not so much, like nothing really to write home about. From day one, that property was paying for itself. We sold it 4 years later and walked away with 200,000 from that property. We never paid a cent. The tenant was paying for the principal and interest mortgage, property management expenses, and leaving some change in our pocket. We only sold it because we wanted to get into a bigger project and made 200 grand from it. We also bought another property, which we still have right now in Melton. And if you remember, if people who know Melton, it was really, not such a good area for most people. Only now, maybe a lot of those people are now being pushed out with the rentals. We bought it for 307. It's now worth 650. So these are just some of the examples. And so we've always bought from a position of affordability. What is it that we can afford right now? In 2024, end of 24, we bought another property in Mandurah in Western Australia. We signed a contract in June. It settled around September. There were some delays. At settlement, it had gone up in value 100 grand, like literally in 3 months. So, and majority of these properties that we've got in our portfolio are less than 600. We've not spent, all of the ones that we have right now, we've not spent more than 600 on those properties. So, yeah, we've always bought from a position of what is it that we can afford right now. And also the other thing for us that really motivates us is like right now, we the capital growth has managed to pay off our home, so we are mortgage free. So I think that's one thing that a lot of people overlook, that you cannot save your way to wealth, but you can invest your way to wealth. You hold assets that some people are paying for, but that are helping you to build enough wealth to eventually get you out of debt.
Wow.
So I hope I've answered your question.
You've answered very well. You said you've bought a property almost every year since you're married. I'm sure they can do the math since 2011. So thank you so much for being vulnerable and
Yeah.
sharing that to us. I'll ask one more question before opening up to the rest of the participants. You mentioned about price caps and that and the fact that it increased last year. Is it at 750 currently for Melbourne, or is it 800,000 for fast home buy
So
program?
first home buyers in Melbourne, up to 600,000, you don't pay stamp duty. So if you wanna pay the 5% and zero stamp duty, you keep it about at 600. Anything above 600, they start charging stamp duty on a sliding scale. And I think they've now increased the cap for the scheme to 850 from memory. 850 or 900 to Melbourne. I have to double check that one. But if you wanted to not pay the stamp duty and not pay the LMI, if you're a first home buyer, you'd keep it at 600. Anything above 600, they start charging on a sliding scale, they start charging your stamp duty. And then if anything above, it should be 850 or 900. You also then start paying LMI, lender's mortgage insurance.
Will the cap increase this year? Is there an indication?
Not really, because what's happening is there's a lot of competition. I don't think so. I doubt. There's a lot of competition now, and there's so many first home buyers obviously wanting to take advantage of the scheme. So I doubt they would increase the property price caps, because that would just make property push prices even higher.
Okay. All right. Thank you. I now welcome anyone who has a question to ask a question. Feel free to raise your hand, and then I'll mention you, and then you can ask your question. Meanwhile, I'll read what has been asked by message. There's a question from Grace asking, how many years do banks allow interest only mortgage borrowing? I thought tax-wise you can only claim interest on the building mortgage and not on the land mortgage interest. I'm sure you can read the question as well, Gracious.
Oh, okay.
If you
So
can
how
address that
many
question.
years? Most lenders were sitting at 5 years maximum, but recently, as of maybe last week or 2 weeks ago, there is a product that's come on the market, which is a 10-year interest only. So 10-year interest only with some lenders, which really is a game changer if you're an investor, because you might look at the market doubling in that period of time, and you're just paying the interest only. And then the other question was, I thought you pay interest only on the building. Is that correct? The
Yes,
other part.
I thought tax-wise you can only claim interest on the building
Mm.
mortgage. The question is not very clear. Grace, are you able
Okay,
to
so I'll
clarify?
try
Yeah.
to
Uh-huh.
answer from what I can understand from there. So with interest only, remember when you buy, when your house is built, or you're now, it's complete, or you buy an existing home, it's now a one-part contract. And because it's now a one-part contract, you pay interest on the whole amount. So your interest only applies to everything. And interest only also helps you to at least claim a little bit more to the taxman, but it applies to the full house. It's not compatible. It's different to stamp duty. When you build, it's a two-part contract, so you pay stamp duty on the land only and not on the building. So stamp duty is different to the mortgage repayments, which is the interest only, where maybe this person is getting confused. So, but if it's interest only, you're paying to the for the whole amount, and then whatever the difference in your repayments and of the interest and what the tenant is paying, that's what they call the negative gearing bit.
Okay. Thank you, Gracious. Um, there's a name here, M, asking how many properties in total. I'll answer this one. She said one property, or in some years, two properties since 2011. So do the math. In your Kabi, are we able to get this recording? Yes, you get it. Let me now go to WhatsApp. There's some questions that have been asked through there. Um, Anne Murray is asking, can you compare between investing in ETFs and buying properties?
I'm sorry, I don't want to be biased. I don't have ETFs. I do have shares, but I don't have ETFs, and I don't want to give you a misleading. You can see I'm more biased towards the property, but I would want to say, look, if that works for you, you've studied. I would say always go into an area that you've really, really studied and mastered. If ETFs works, then, definitely by all means, as long as you invest your funds.
Thank you, Precious. Another question, still on ETFs. So maybe I'll skip this and just tell them to really study that area before making an investment. I'll go back to Zoom. There's a question from Irene asking what strategies to reduce mortgage and increase equity.
So strategies to reduce mortgage, like what I said, is if you can have investment properties working for you. And just to remind you on that graph that I showed, on that little table that I showed you, so you're holding assets that other people are paying for. But literally, those are the assets that are going to help you get out of debt. So what you do is once your investment properties have increased in value or hold enough equity, and now we're seeing lots and lots of our clients do this. Some were in markets like Queensland, where some properties doubled in 6 years, in Toowoomba, in Brisbane Metro. So what we do is what we call debt recycling, where we pull out all the equity from the investment property, we clear the home loan, then we maintain the investment debt for tax purposes. Because remember, investment debt is good debt. During our active working life, we want to maintain that so that we don't give away too much money to the taxman. And then at the end, when we transition into retirement, we can start selling some of the investment properties and paying off the others. But at that point, maybe we're no longer earning a higher income, so we minimize the capital growth, the capital gains tax, and we also minimize the tax that we would have paid during our active working life. So I hope that makes sense.
Yes, thank you, Gracious. Another question here from M. Bought an investment property, an investment apartment 5 years ago. Given the current market, would it be wise to sell it now and invest in a house and land instead? What factors should I consider before making this move?
Yeah, so that's now a very specific situation. So you would rather sit down. So you would have to sit down and look at what has been the performance of that apartment. Has it really performed as you expected in value? And if not, then I would say yes, cut your losses, sell it and get into a better market, and maybe get into a market, a high growth market where you make your money, most of your money in the short term. You also don't want to get into a market where you hold for 10 years before anything happens because you've already lost time holding the apartment. But like I said, it's a more specific situation. You would need to look at how has that apartment performed. Are you happy with that? If not, then cut your losses, get into a high growth market.
Thank you. thank you, Gracious. I think I'd recommend her or him to reach out to you. I'll share the contact, and then maybe you can
Yeah.
have a more a better discussion on what strategies to implement there. Hmm. M is saying, I think it's a question following what you just said, but apartments are about to boom in Melbourne. What do you have to say about that?
I saw that one. I'm not sure about that because I just think there's an oversupply of apartments in Melbourne. I really think there's an over. I'm not sure about the boom. I might have missed that bit, but yeah, I would think there's a really an oversupply.
Okay,
Mm.
thank you, Gracious. Anyone with a question? Justin, you seem to have a question. George?
No question per se, just to say thank you to Grace, yes, for your presentation, very informative, and good to see our community mindset individually and collectively change about investing and um, countering misinformation that has plagued our communities, African communities, I should say, for many years. But now we have role models who are walking the walk and yeah, good is a good example, Gracious. So good. Thanks for taking the time to come and speak to community members. Hopefully, one day we'll do it in person, and you can come and and do so. But that shift in mindset over the last few years is encouraging, and looking forward to people making taking decisive action to um, invest in things that they understand, as you said, which is very important, um, and also invest where they are. Because one thing that I'm sure the same thing with the Zimbabwean community, Kenya community, we tend to we have an affinity for buying things that are far away back home, believing one day we'll go back there and retire. But I think reality has shown us that we don't know about tomorrow. You can find yourself here for many, many years into your old age. So very important to invest what you understand and invest where you are, where your roots are. Happens to be here. Not go ahead and invest at home, but don't neglect where you are. So thanks, Rolly, for moderating and putting this together. And
No more
George, maybe
questions,
you can
Justin.
share a few words.
Yeah, most definitely. I think I'm just gonna echo Justin's and Rolly's comments and sentiments on the session. It's been quite an insightful session, Precious. And I think as just like many others, we've learned a lot. Uh, I just have probably one question. Well, I wrote two of them, but I'm going to ask one question. And this is mainly because of, the experience that you've had yourself. So are there any secret tips to buying profitable properties and investments? Just because, at this stage, sometimes you might start off well or start off, have a rough start, like you say, how you guys started buying a property and which wasn't very very profitable. So are there any lessons learned, in your investment journey that would probably help someone who's starting that way?
Good question, George. I think yes, we've definitely learned a lot of lessons, and we've also lost money at some point. So, and some of our biggest lessons have been through the failures. So don't be afraid to make a mistake. But I would say let not the fear of failure uh, hold you from taking action. So I would say some of the tips would be look at areas that don't have a lot of supply. So if you're getting into an area, look at the supply of land. Areas that are well established always means, there's no longer land coming in the area. So in terms of growth, that will happen quicker. Look at land size. So, like I said, land is what increases in value. and not the building. And look at the upsides. What are the upsides? So just like you drive through McDonald's and they ask you, would you like to an upside, you know, to upsize to a large chips, etc. Similarly with property. So look at whether, you know, there's and again in Victoria, since the beginning of this year, no, last year, they have now approved dual occupancy. I don't know if you dual OXO, meaning you can have a house built like a one house, but with 4 bedrooms that are self-contained, 2 bedrooms that are self-contained, and then you can get dual rent. So look at things like that where you can have some upsides, where you can potentially put a granny flat in future. Look at something where you can go in and do a cosmetic reno, for example. So cosmetic reno meaning, you know, just a lick of paint, change some lighting and improve the rental or improve the capital appreciation of that property. So look at all those things, and I would say if you are starting, compare apples to apples. So don't try to look at 10 suburbs. Narrow it down to 3 suburbs. Attend as many auctions as you can. And I did that. I would attend auctions with a book. I would write, okay, this sold for 650, but the asking price was 620. And then I would know, okay, so it went 30 grand above the market. I would do that until, you know, I've done a lot of properties and I would really have my finger on the market to know exactly where the market sits. And then that would be easier to identify undervalued properties where I could go in and quickly do a cosmetic reno and make some money, increase the rent and increase the value, pull out equity from that property straight away. So you can look at all those things, and I'll tell a quick story. We had a client in 2021. We purchased a property in Brisbane in an area called Paddington. She wanted to do student accommodation. And like I said, all our properties are below 600. So she purchased theirs for 984. And I was like, man, this is an expensive investment. But it was in the city, so closer to uni. She ended up not doing student accommodation. The laws in Queensland were a bit more stringent. So she rented it out to a normal tenant. Fast forward to last year, which is 4 years later, we managed to pull out 500,000 from that one property. We cleared their mortgage, and she still has 400,000 left equity in the one property. So she doubled, that property doubled in 6 years. So look at those areas that are closer to uni, closer to amenities. And again, it's not about buy. I'm not sure if you've heard the term about buying the worst house in the best street. So the house doesn't have to be a Rolls Royce, as long as it ticks all your boxes, you know, closer to amenities, shops, public transport, in a good suburb. Then you know you and tick off all those things that you should put that as a consideration. And also as you look at more and more properties, you start to have an eye on what are the quick things that I can change in this property to increase the rent or to increase capital appreciation.
Thank you. Thank you for that detailed response, Gracious. Yeah, so I think
George, I had requested Gracious to stay a few minutes past 9 because I anticipated that there will be a lot of questions. So feel free to ask your second question if you want to ask. Do you want to ask?
Yeah, I could ask the second
go ahead.
question.
Yeah.
Yeah, so I think the second question would be with regards to, so if let's say I get assessed to having, let's say, a borrowing power of, let's put it in figurative terms, say 500,000, right? Is it advisable to max out that 500,000, or is there something like a percentage that would be safe to borrow from? Because this is what I usually hear a lot from brokers or maybe financial advisors, that as much as you might be assessed, to have a certain borrowing power, it doesn't mean that you have to borrow that amount to max it out.
Good question. So your mortgage repayments should not really exceed 27% of your income. But I would also say, let's say you are looking at a $600,000 property or 500,000, like you said, and the repayments are 2,500 every month. I would say put that money away for 3 months and see whether you are capable of putting that. So the capacity aside, you've been approved to you've got that capacity. But can you put that money away every single month? So if you're paying rent, maybe 1,800, calculate the difference from the rent, put it into your bank account every month for 3 months, and then see whether, you're not choking. And then that's how you realize that, oh, probably I should not max out the borrowing power. So it's not about maxing out the borrowing power. It's again buying from a position of affordability. Can I be able to afford this without living on 2-minute noodles or, that kind of thing? So it's just, buying from where you can afford. You don't have to max out the borrowing power. And I also find out that a lot of people and a lot of Africans want to start with a $2.5 million home or 1.5 million, the Rolls Royce. But I always think that by the time you surface from that mortgage in 5 years, even though it was within your borrowing power, the market would have moved. So rather than start at 2.5 million, manage to, it's entered the market at a point where you can be able to quickly re-enter back into the market. Because what happens with a mortgage is the first 5 years, 80% of your mortgage repayments are actually going towards the interest, only 20% towards the principal. So, in 5 years, by the time you're not even reducing. So you'll be logging in and seeing that there is no movement in this loan because 20% only is going to the principal. The rest is going to the interest. So it's not just about buying the Rolls Royce, get into the market. And once you've built up, you can always then, buy the forever home at some time when you've got a few investment properties under your belt that are working for you. And you've also not used all the borrowing power on one house.
Yeah, thanks for that, Precious. Rolly, I don't want to hold all the questions and all the time, so I'm happy for you to.
Okay.
Yeah.
There's some questions that have come through from MOM. What are your thoughts on the government scheme of them owning a part of your home to help you get into the market?
So the home to help one, I don't really like it because the government owns part of the home. So they owns 25% of your home. But the requirement is exactly the same as the Australian deposit scheme. So you still need your 5% deposit. You still need, your stamp duty depending on the purchase price. But the government, so it means you cannot make a decision on that property without inquiring. It's like going into something with a business partner, whereby, if we think of pulling out equity, we have to have a meeting with the partner. If we think of selling, we have to have a meeting with the partner. So the requirements for that home help scheme are exactly the same as the Australian deposit scheme. So you'd rather either lower your budget and go in by yourself and not have to be reporting to the government, etc., etc.
Questions. Gentleman here, I found a lady. What was your property buying strategy? Was it more affordability or was it more of property gaining value? I don't know if maybe you could just answer that quickly.
Yes, so ours has mainly been buy and hold. Buy and hold, just getting into those high growth areas and then buy and hold with the idea that we don't want to hold for too long before it increases in value because we want to generate enough to then pull out some and buy another one and buy another one.
Okay. Thank you, Gracious. Maybe just one final couple from me. If you can, from where you sit, I believe you're Zimbabwean. You serve different 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 citizens from different African countries. Maybe you can share with us what maybe Kenyans can learn from the temperaments from other citizens, or is there something that you've seen other Africans should benchmark themselves from Kenyans? What can we learn?
Uh, I think I'll go back to what Justin said. I think we are all Africans, we are all the same. We really we are very patriotic at heart. We love we love our countries. We really want to invest back home, build back home. And there's nothing wrong with that. But let's not forget like what so they're all and we are all the same, and I've seen this. Zimbabweans are the same, Kenyans are the same, Zambians are the same, South Africans are the same. They're all wanting to really invest back home. But like what Justin said, don't do that at the expense of you then having to not have anything here. You pay a mortgage for somebody else if you're renting, maybe for 25 years you're renting. Or if you own your own home, you have to pay a mortgage in 30 years because you don't have any investment. The investments are back home. So I would say invest where you are, which will then help you to get out of debt here. And it will actually build you some good equity to invest back home if you then choose to. But don't again over trust the people that we left back home. Uh, some of us left our brothers and sisters, and we still think they're the same people, but they are not. The hardships and they change people. So focus on where you are, and remember at retirement, if you've got your properties, you sell them, you can still be able to walk away with a substantial amount of money to live comfortably back home, but you've not lost a lot of money trying to do things in your absence back home. So I think that's a common trend that I've seen in Africans.
Thank you, Gracious.
Very well said, Grace.
Any further comments, Justin? Or that's it?
No, just to thank Grace again for taking the time, and the attendance today has been good. But it's encouraging to see the shift in mind shift for people to look at being curious about how to spend all the hard-earned money they earn. And probably another thing to add is just make sure that the company you keep can also have an impact on your financial well-being. So make sure that if the company you keep is not adding value in one way or the other to even the financial literacy part, then you may need to prune your relationships, because we are now a mature community here. We've been here for a long time, and we need to just demonstrate some maturity in that sense, and being able to be very intentional about all matters well-being, including financial literacy. So, Gracious, thank you very much. Asante sana in Swahili, as we say. And I look forward to future sessions. Hopefully you'll come back. We didn't scare you away, but
No,
we'll
thank you. Thank you so much for the time. Really appreciate being here. Thank you for the invite.
Yeah, thank you.
excellent. Over to Rolly. Excellent.
Gracious will come back. The attendance was good, Gracious, and the comments were also positive. We had one person saying that your story was very inspiring as a message. I'm sure you saw that. She'll come back again and talk about the importance of a buyer's agent. I think her husband runs a company that acts as a buyer's agent. Maybe just as a how do we as a teaser on what will come in the future, Gracious. Maybe you can just describe who a buyer's agent and why should people attend when you become next
Yes,
time.
so good point. So a buyer's agent represents the buyer. So you would know we've got the seller's agent. So the seller's agents is not really representing you. They're representing the seller, but the buyer's agents represent you. So they do all the legwork they research on those high growth areas that we were talking about, and they go for open inspections and buy a property on your behalf, the property that ticks all the boxes, that ticks the investment strategy. So that's what a buyer's agent does. So it's like having someone in your corner helping you build a property portfolio. I think he will come and talk about which areas to buy, like just building up on probably what I have done. So that if there are people who are keen to look at where to buy, then they can be guided by the data and not just go blindfolded.
Okay. Thank you, Gracious. I think I'll now bring the meeting to a close. I appreciate everyone for finding the time to attend on a Monday evening. God bless you, and see you again next time.
Asante sana.
Thank you, Gracious. Thank you.
Thank you.
Bye-bye.
Bye-bye.